Hi, everybody. A very good morning to all of us. I would like to express my gratitude to PEMNA Secretariat as usual, the World Bank, the International Monetary Fund, the European Union, if any, and PEMNA's communities of practice and budget, and everybody that I cannot mention. Like we know that we have passed a very tough 2020, but unfortunately, the COVID-19 pandemic has not been over yet. So we've seen that many countries are still struggling in tackling the impact of this pandemic. If we look back at what have been done to handle the COVID-19 pandemic, most countries have responded with various policies that are extraordinary and unprecedented that we already discussed last year. And expansionary fiscal policy during this time is inevitable. Significant amount of government expenditure has been released to mitigate the adverse impact of the COVID-19 pandemic. This counter-cyclical approach of economic policy certainly has an impact on significant increase in debt, considering that state income cannot be relied on when economic conditions are sluggish due to the COVID-19 pandemic. So the significant increase in debt should be managed properly in order to maintain fiscal sustainability. Considering debt management being very essential issue in public financial management post-COVID-19 pandemic, we expect to utilize this forum as an experience and knowledge sharing platform to deliberate our main topic today. If I'm not wrong, is debt management with a focus on ways to bringing down the debt level during the pandemic. This is also a forum for us to confer and address public financial management challenges we are facing today and ahead in order to adjust with the pandemic. The global economy is still full of uncertainty as the pandemic has not been ended. However, optimism is there and vaccination have given hope that victory against this pandemic will soon be seen. So we confident that 2021 will be a better year. The year of 2021 is a transitional period for handling the COVID-19 pandemic and economic recovery. Most governments still have to take counter-cyclical policies, which will again increase debt. Therefore, debt management will be our discussion in this webinar really matters. As a peer learning forum of public financial management practitioners, through this forum, we hope to be able to learn from the expert as well as multiple countries' experiences delivered by PCoP fellow members regarding debt management post-COVID-19 pandemic. We expect that through this webinar, we could also exchange our thoughts and conclude with fresh ideas on debt management post-COVID-19 pandemic. Once again, we can go better in this year of 2021. Finally, I would like to extend my warm welcome to all of you. We hope that this webinar will result in rewarding discussion for better improvements, and this would be an enriching experience for all participants. I am grateful for the opportunity to speak to you today and to be a part of this important forum. Thank you. So I come back to you, Kim.
Perhaps I can take this a moment. I'm Bernard Myers, the facilitator for the budget community practice from the World Bank, and it's my pleasure to also introduce Lars Jessen, who is a lead debt management specialist at the World Bank. Lars has been at the World Bank since 2002, working on a wide variety of countries across the globe, including a couple PEMNA members, including Indonesia, Thailand, Lars, before joining the World Bank in 2002, Lars was a special advisor in government debt management for the Danish Central Bank. And during this course of his career, he's really contributed to the development of sound practices in public debt management, provided technical assistance and training, as well as developing and implementing debt management reforms in a variety of countries. So he specialized very much in debt management, including asset and liability management, risk modeling, as well as management of contingent liabilities. Lars stays quite busy, but we're really honored that he could join us for this webinar, looking at how countries can best respond to COVID-19 and some of the strategies that are available. So we are going to take about, we'll have about a 30-minute presentation and then allow about 30 minutes for Q&A. So without further delay, I'd like to give the floor to Lars.
Thanks, Bernard. Many thanks, and thanks to the Secretariat, and thanks for giving me this opportunity to talk to you about debt management and the crisis. When I prepared for this, so this is sort of before I start my presentation, when I prepared for this and thought about how to address you as public finance management experts, I was coming to this from an expectation that there would be no debt managers in this webinar, and it turned out I was wrong, and I was not only wrong, I was very wrong, because I see that there are many of my old friends attending here. Boloma from Mongolia, Pa Erwin from Indonesia, Kunzius and team from Thailand, and actually both Erwin and Sius, these days I meet with them almost on a daily basis, so it's great to see you here. Even though there are quite a few debt managers, I still think it makes sense to sort of start off by talking a bit about what debt management is and how I see debt management fitting into fiscal policy and sort of the core areas of what you guys are doing. And I should also say that debt management is important. Debt management is critical in this situation of crisis, but debt managers cannot help bringing down the debt level. That's a fiscal policy exercise. That's a fiscal policy activity. As I will talk a bit more about later, the main driver of the debt size is the primary deficit. That means that's completely outside of the control of the debt manager. Having said that, the debt manager is controlling some really important elements that can lead to crisis, that can make crisis worse or soften the impact of a crisis. So what the debt manager, the role of the debt manager is to decide what to borrow and when to borrow, but not how much to borrow, because that will come from the deficit and of course the debt service payments on the existing debt. Let me try to see if I can share my presentation here. Even though we have done this for more than a year now, it's still exciting to see every time if it works. You can see the presentation?
Yes, we can. Thank you.
Perfect. Thank you. So the title here is COVID-19 Debt Management Crisis and Response. And as I said, I will start off by talking a little bit about debt management, what it is and what it isn't, and how it fits into this framework of fiscal policy and monetary policy. The main part of the presentation is to walk you through a framework for addressing the crisis. It's a framework that was actually, it started off as an exercise in trying to clarify our own thinking within the World Bank on how to address this crisis, how we could support countries. The presentation here is relatively short, but there's a range of papers that were produced as background notes. we come from a point where it's very clear that not one size fits all. And I think towards the end of the presentation, I'll give some country examples of actions that countries have taken, and you will see that there's a huge variety. And this really tells you that countries are not the same. And when it comes to debt management, they're definitely not the same. It does make a difference whether you are Germany that can issue 30-year bonds in their local currency at negative interest rates, or if you are a low-income country that cannot raise sufficient funding in your local market, but have to borrow in foreign currencies and often at interest rates at 10% or higher. So of course, the constraints and the options that are available makes a big difference for a debt manager. So what is debt management? Debt management became a sort of specific and specialized topic. Now I say recently. That's in many countries, most OECD countries, this happened 25, 30 years ago. Prior to that, debt management was seen as sort of a subtopic to fiscal and monetary policy. It was seen as part of budget operations. Once you had done all the wonderful things that you wanted to do with your budget, there was a deficit and somebody had to borrow to fund that. And it was the main criteria when it came to borrowing was identifying funding, not too much focus on what you borrowed and where you borrowed. And for example, that was definitely the case in my home country, in Denmark, in the 1970s and 80s. And the result was a debt portfolio that was very, very risky, with a lot of foreign currency debt. In other contexts and in other countries, debt was issued by the central bank on behalf of the government, and often, and this is still the case in some countries, debt and government borrowing is essentially seen as a monetary policy instrument used by the central bank to control monetary policy. But what we have seen is a clear trend towards separating debt management from fiscal policy and monetary policy. And that has been done as a way to resolve policy conflicts, but also to enhance policy credibility and accountability. And we have seen the creation of debt management offices, so specialized units either within the ministry or outside the ministry. And good examples of that, Thailand, Indonesia, but we also have countries in your region where there are still challenges from an organizational point of view. For example, in Vietnam, where debt management is quite fragmented. In the Philippines, that's to some extent still the case. You have countries where you have, I tend to tease my friends in Thailand and Indonesia because they have very, very large debt offices. That means they have access to a lot of resources, a lot of people, a lot of smart people. And if you take the other end of that, you have a country like Laos, where you have a very small debt office. Only very few people are engaged in debt management. So you see a huge variety, but a clear move towards making debt management a separate policy. And that will hopefully become clear on this chart, where what I've tried to do here is to say, well, we have three policies. We have debt management, fiscal policy, monetary policy. So I'm a debt manager, and in my mind, debt management is really, really important. Of course, I'm aware that fiscal policy and monetary policy are dominating debt management, and they should be dominating debt management. They are more important, but what is critical and important in this chart is to recognize that debt management has separate objectives and it has separate instruments. And therefore, it makes sense to separate debt management from these other policies. So the objective for debt management, and I'll talk a bit more about that on the next slide, is to minimize cost. So minimize the cost of the debt, the interest cost, subject to risk. And again, on the next couple of slides, I'll talk a bit more about what is risk on a debt portfolio. So that's the objective: minimize cost, take into account risk. The instrument is the composition of the debt portfolio. So that composition is decided mainly through new borrowing and also in some cases on active operations in the market. And there will be some examples of that towards the end of the presentation. Fiscal policy is about resource allocation. It's about redistribution. The instrument for fiscal policy is the composition of spending and taxation. So fiscal policy is the main determinant of the level of deficits and debt. And this is important here, that when we talk about debt sustainability, that is an objective that cannot be met by debt management, because the main driver is the primary deficits. They will decide whether or not the debt is growing faster or slower than the growth of the economy. So when we talk about debt sustainability analysis, that's an exercise for the fiscal policy people, the macro fiscal unit typically in the Ministry of Finance, whereas analysis of the composition of the debt, development of the debt management strategies, that's the role of the debt manager. And then just finally, to complete the picture, monetary policy is typically the objective is price stability, and the instruments are interest rates and exchange rates and money aggregates. So what are the main objectives for debt management? Well, there are different formulations, but they tend to focus on these three examples that I mentioned here. The most basic is to finance the government on a timely basis, meaning that whenever there's a funding need, the debt manager should be able to raise that funding either domestically or externally to minimize cost, but to take into account risk. And then finally, it often includes a target to promote the development of the domestic debt market. So the idea on that last point, and I'm not going too much into that, is that through the debt management policies, through domestic borrowing, you can support the development of a domestic financial market that will then help broader capital market development. Typically, these objectives are formulated in the debt management law, meaning that they don't change frequently. The translation of these overall objectives then comes through the debt management strategy, which is sort of the key document in debt management. It's the key policy document. A debt management strategy is a rolling medium-term plan that will specify the way the objectives for debt management will be met. So that means it expresses the preference with regard to cost-risk trade-offs and express the characteristics of the desired debt portfolio. If we take two of the countries that are present here, and if we talk about risk for a second, Thailand's public debt portfolio is all exposed to Thai baht. That means there's very, very limited exposure to foreign currencies. Indonesia is a more typical developing country debt portfolio where you have a large domestic debt, you have a range of maturities, also long maturities issued in the domestic market, but you also have a substantial domestic external debt, and you have substantial external borrowing every year. And that's a reflection of the fact that the domestic market is not large enough to absorb the borrowing of the government, so you have to move outside. And once you move outside and borrow in foreign currencies, that means more exposure to your budget. Because if your currency depreciates, there will be an immediate effect, an increase in the cost in your local currency that will hit the budget. So that means from that, and this is a super simplified example, that means from that perspective, Thailand does not have any exposure to foreign currencies. That means whatever happens to US dollars and Japanese yen, etc., that doesn't affect the cost of the debt. Whereas in Indonesia, changes in FX rates will have immediate impact on cost and on the size of debt. The purpose of the strategy document is to provide a navigation chart. It's a very important element in transparency and accountability. And the reason for that is that what the debt manager is doing is that he or she is taking risk. There is a funding need today, so we need to borrow today, but we don't know what will happen with interest rates and exchange rates going into the future. That means we don't know what's the best way of borrowing. We may have a preference for 5-year domestic, but we don't know if that's the best way of borrowing. We will only know that in the future. But the fact is that we need to borrow today. That means we have to think about what would we like our debt portfolio to look like? What do we perceive to be the optimal debt portfolio and therefore the optimal trade-off between cost and risk? And we need to tell that to the public. We need to tell that to politicians. We need to have a formal document that is approved by either the Minister of Finance or Cabinet so that we can publish that and show the world that this is what we're trying to do. Because if we don't do that, everybody can come back after the fact and say, well, yeah, you borrowed in US dollars, but it would have been much more cost efficient to borrow in Japanese yen. So why didn't you do that? And after the fact, it's always easy to say what you should have done. So that also means that this document provides continuity. It means that it makes life harder for politicians, for ministers to change debt management policies, to change strategies. It means that instead of having an opportunistic focus, meaning you decide what you think is best right now, you force yourself to think ahead and to think in a strategic fashion. So that was the brief introduction on debt management issues. And for quite a few of you, this you knew that beforehand. But I think the main point I wanted to make is that the debt manager is not responsible for the size of the debt. The debt manager doesn't decide how much to borrow. What he decides is when to borrow and what to borrow, but not how much. So coming to this crisis framework, and it sounds very fancy, but it's actually not. As I said initially, it is a way that we used internally in the World Bank to try to organize our thoughts and to try to think through how can we best help countries in these really difficult times. And the starting point, of course, is to find out, well, what is the impact of COVID-19? And I think if we start from the bottom, that's the key point here. It's uncertainty, right? It's even more than 1 year after the outbreak, uncertainty is still what is dominating our thinking. The effects when it comes to markets have been probably less dramatic than we had feared when it comes to developed countries, when it comes to OECD countries. The higher middle income countries, there has certainly been an effect, but less than we would have feared. But we have also seen countries that are in debt distress. Examples are Chad and Ethiopia in Africa. And it's important to, when we talk about crisis and debt management, that before the crisis, we had actually, in the years up to the crisis, we had seen a movement towards more and more countries getting or moving towards debt distress. That means that for many countries, their starting point is a very serious one, where they are close to their debt becoming unsustainable, and then you have a crisis. So uncertainty, I think, is the key word, but what we have seen is a downturn in the global economy. We have seen increased expenditures related to COVID, and we have seen some dislocation of financial markets, but probably less than what we had expected in March last year, and certainly for countries like Indonesia, Philippines, there was an effect on spreads when we look at the external borrowing, but the spreads relatively quickly came back to the pre-crisis level. So I think it's fair to say that the dislocation of the financial markets have probably been less than what was feared. But again, the uncertainty is still there, and I think it's clear that we are definitely not out of the woods yet. We are not out of the crisis yet. So what are the challenges for debt managers when it comes to debt management? Well, it's operational risk. So that's about ensuring that you can raise the funding that you need. It's ensuring that the payments can be made. And it's some of it, and I'll come back to that in a few moments. Some of this is very, very basic. That's if you are in a close down, do you have access to your systems from home? Do you have enough laptops in your debt management office that you can allow staff to work from home? So a lot of the operational risks are basic, but came as a surprise. Not many countries had actually prepared for this situation. When we talk about funding, it's meeting the increased funding needs, investor confidence. I think that's actually an area where there's reason to highlight a lot of the countries not only participating today, but broadly in both Africa and Central and Eastern Europe, a lot of focus on communicating with market participants, explain to primary dealers, but also other investors what you're trying to do, that these are uncertain times. You may change the way you issue debt, you may change the instrument that you're issuing, and in that process, it's very, very important that you communicate and make access, make information available to investors. And then finally, and again, the last point is related to the increased uncertainty and related to fiscal risks. It is uncertain still in many cases what the funding needs will be. They may continue at this elevated level for years to come. We have seen quite a few countries providing support to small and medium-term enterprises through guarantee schemes, etc. There may be guarantees that will be called in the coming years. There may be guarantees from state-owned enterprises that, due to the economic slowdown, will be called. So clearly there will be elevated risks related to contingent liabilities. So what can debt managers do? And what I will talk about on the next couple of slides is sort of this. I mean, we're talking about a framework for crisis management. That means this is a simplified version of the world, and we are not claiming or saying that this is something that you just apply this from 1 to 4 and then problem is solved. Not at all. But it's a framework that is focused on forcing yourself to cover all the bases, not forgetting anything when you look at your risks and when you decide how to operate. So the first point is about safeguard business continuity. That means allow yourself and make sure that you can continue to make payments on your debt, make sure that you can raise new debt as you need to. The second is to find out what is your funding need. And this is where you have a communication with the Fiscal Policy Office, with the Budget Office. What are the plans that the central government is having to support the economy? What will be the impact on funding needs? And if you can certainly have situations where the funding needs are such that the debt manager will have to go back to the Budget Office, to the fiscal policy people, and explain that, yes, we agree that these are sensible plans, but we will not be able to raise these amounts of funds within this time frame. So that's certainly something that that communication needs to take place. The third is about ensuring sufficient and timely funding. I talked a bit about that. And then finally, it's supporting market functioning. That again is very different whether you are Indonesia or whether you are Laos. If there's an active market, you want to do the best that you can to support that market. And we have certainly seen some interesting examples of how to address this issue. So I'll go through these 4 points one by one with a bit more detail, but not too much detail. So safeguarding business continuity under extreme circumstances. The proposal here is the first step is to establish a crisis committee, because one thing that always happens in a crisis is that different parts of the government start running in different directions. And when we talk about debt management, having a coordination committee with the Debt Management Office, the Ministry of Finance, and Central Bank, that will definitely help avoiding mistakes, and it will clarify funding needs, funding options, and whether and how it's possible to fund the government. A critical point is making sure that you can continue to make your payments. That means that you need to have access to your debt recording systems so that you can initiate the payments. You need to make sure that the information can flow even if you cannot go to the office. And I mentioned the example of laptops, and that example is actually from South Africa, where when they had the first close down in the offices in Pretoria, they realized that they relied on desktop computers, and only very few people had laptops they could bring home. And they also realized that for the people who could bring the laptops home, only a few of them could actually access the systems in the Ministry of Finance. On top of that, they had these daily cuts in power, meaning that all sorts of technical challenges that were not really, nobody had thought that this could happen. So there was no preparation for that type of operational risk. The third is about that you have operational procedures in place for borrowing, ensure that you can continue to issue debt as you need to. The typical example is actually similar to the one about initiating payments, namely access to auction systems, being able to hold the regular auctions, being able to issue new debt. Scrutinizing the government's funding needs. This is basically about ensuring that you have the cash that allows you to make the payments on debt. In the short term, it's about revising your funding needs. It's about finding out how much debt you need to issue going forward. This is where this coordination committee becomes critical, having these discussions on a day-by-day basis, at least at the initial phases of the crisis, and where things really hit you. You need to have cash forecast. You should produce cash forecast as a standard as a standard exercise in the Ministry of Finance. Especially in developing countries, this remains a challenge. And for countries that do make forecasts, often the forecasts are of poor quality and they are not updated often enough. And then the third is developing contingency plans. I think one thing we've learned already is that things can become really bad. So you need to think through, if in the event that, for example, you're not able to issue debt in the next month, what are the options that we have? What can we do? Timely and sufficient funding. One thing I'll come back to on the last couple of slides when I talk about the country examples is the use of central bank not only stronger coordination, but also central bank funding. This is something that I think if we go back 1.5 years, most of us would argue that you should never go to the central bank and have them fund you either directly or indirectly. This is, if we look at a balance sheet of the government, the central bank is part of that balance sheet. That means that if you borrow from the central bank, you are borrowing from yourself, and this will end up becoming monetary funding. It will end up in inflation, and I think that I'm sure that Indonesia will talk about this. I think that they have established a framework and a scheme that actually works really well, and I think is very, very sensible from my point of view as a crisis instrument. The difficulty will be to get out of that once the crisis is over and to close that scheme down. I think that will be a general challenge. And I also think that part of this discussion, this is not the topic of today, but what we have seen after the global financial crisis in OECD countries, in EU, in the US, is a much, much more active role of central banks compared to what we would have considered reasonable 2 decades ago. And the main reason that this thing seems to be working is the super low interest rates level that you see in developing countries and with negative rates in many cases. Another activity or action that we've seen is that central governments are looking outside of the central government to identify funds, to identify surplus cash. This could be with some state-owned enterprises, it could be with line ministries, but making sure that you use all available cash before you force yourself to borrow. Investigate the scope for multilateral and bilateral loans. For some countries, that's not an option, but for others, it is, and that's definitely something that you should pursue. I've been told that I have 2 minutes left, so I will speed up a bit. What we have seen is also that countries adjust what they issue, how they issue. So moving from longer term maturities to shorter term maturities, having more frequent auctions, issuing directly to market participants outside of auctions, etc. So this is really about where you have to think outside the box and use all the options that are available. And I think that thinking unconventionally can actually be very, very helpful in a crisis situation like this. There are some actions listed here regarding supporting the domestic market. In the interest of time, I'm not going to go into them. I think it's if I spend my last 2 minutes on the on this slide and then the examples, and there's actually not too much to say on this. This is sort of almost like a commercial in the middle of the presentation. This is what we think from the point of view of the World Bank we can contribute to debt managers. This is what we call just-in-time support, meaning that these are not these big fancy programs, but if you have issues where you would like to either discuss with us or having our support, these are some examples where we could help you. So the first one is a review of the operational risk management framework. Second, adjustments in the debt management strategy. We, as many of you know, we apply this medium-term debt management strategy tool, allowing to compare different funding strategies. We have developed a toolkit focused on assessment of fiscal risks, a review of the market issuance program, where there's a tool called iPad, which can help you organize your domestic issuance. improving cash flow forecasting and cash management. As mentioned, this is really critical. Scaling up investor relations activities. And then the last one is about domestic market tools. I have updated information, so now I have 5 to 10 minutes. So I will go back down into a slower mood, but spend a bit more time on these examples here, because I think it's actually more interesting to see those than to go back to the previous slide. So these some of these examples are not totally up to date. They may not be exactly precise the way we have organized them, because one of the challenges is to get information, right? But if we look at countries that have borrowed from public sector entities, so what examples can we find there? Finding liquidity in line ministries, in state-owned enterprises, that has something that has been pursued in Colombia and Ukraine, meaning that you are basically borrowing on a temporary basis from these state-owned enterprises. You are taking their liquidity and you avoid issuing debt. We've seen central banks purchasing government bonds in the secondary market. This is totally in line with what we have seen in the US, in EU, and there's a long list of countries where the central bank have done that. We have also seen central banks buying bonds directly in the primary market, which is typically something that we recommend that countries are not doing. But I think that's one of the examples of thinking outside the box and really recognizing that there may not be any alternatives other than having the central bank providing support on a temporary basis. What is interesting with this list of countries is that that covers a lot of the countries participating today: Indonesia, Philippines, Malaysia, Thailand, and then also Fiji and Ghana. We've had direct repos between central bank and MOF, like in the Philippines. We've seen allowing overdrafts, UK, India, the use of sovereign wealth funds in Angola, and then drawdown of cash buffers of fiscal funds. The last one is interesting because this is actually countries that had put money aside for situations like this. In the case of Brazil, those funds turned out to be much too low. But it is interesting that these are countries that had actually thought about, well, we need to have extra cash because we may need it if there's a crisis. What have countries done when it comes to adjusting funding plans and strategies? We've seen a lot of these COVID-related bonds, so there are more examples on the coming slides. But Indonesia, solidarity bonds in Colombia. So these are sort of these type of bonds are actually becoming quite popular in general. We refer to them as thematic bonds. So it's bonds with sort of a headline, and importantly, a bond where you specify how you're going to spend the funds that you are raising. That means you're creating sort of a small box where you're saying, well, I'm borrowing 100 and then I'm going to spend 100 on this specific activity. So this is exactly the same as green bonds that Thailand, Indonesia, etc. have issued, where in the case of green bonds, you say, well, I'm going to spend this money on renewable energy, for example. So to some extent, it's a way of attracting new investors, to attract investors that are interested in specific types of bonds. In the case of COVID bonds, is to create sort of solidarity and to get people to recognize that we are all in this together. And if you have funds, you can help us try to solve the problems. We have seen a shift towards shorter maturities in quite a few countries. We have seen countries increase in the number of auctions, but we've also seen countries suspended the auctions and just have had auctions whenever there was a need to raise funding. So sort of skipping the calendar that is normally recommended. We have seen liability management operations in the case of Mexico, switching from longer to shorter maturities because there was interest among market participants. And we have seen a huge demand for borrowing from the World Bank, Asian Development Bank, etc. We've seen an increase in countries issuing in the international capital markets. That was a trend that had started a long time before, a decade before the COVID crisis, but it's certainly something where especially the higher middle income countries, where spreads are back to more normal levels, where this is quite attractive to issue internationally. We have seen a lot of these special COVID bonds. I mentioned Indonesia, but also in Fiji, Colombia, Guatemala, Ghana, etc. And these are all, there's no sort of standardized way of doing this, but what they have in common is that they have this theme that you try to attract, especially domestic investors, by arguing that, well, we have this problem. It's a common problem, and people who have funds to invest should buy these bonds. And in the case of Italy, they have included a premium. So if you hold on to the bond until maturity, you get a premium. The measures to help the market. I didn't spend too much time on these more market related issues, and I'm not sure there's so much interest in this with this audience, but still it's worth mentioning that most countries have made adjustments to who can access, for example, credit tenders in the case of Hungary and Indonesia, India, providing increased liquidity to banks, but also non-bank financial institutions through central banks. So made it easier to basically providing more liquidity to the market through reducing liquidity reserves, and in the case of Turkey, to make it easier for primary dealers to participate in open market operations. And then finally, there's been countries like Angola who have started privatization as an alternative to borrowing. And we have seen, in some cases, a quite substantial increase in the issuance of guarantees. South Africa, Sweden, Austria, Italy. One interesting development is also going back to the borrowing, that we've seen more focus on retail bonds. So bonds that are specifically directed at private investors. I've talked about primary dealers, and I didn't explain what that is, but that's basically professional institutions that have exclusive rights to participate in the auctions of government bonds. So in a typical country, they may have 8 primary dealers. These are the only ones that can buy the bonds, and then they will sell to the secondary market afterwards. This is what we refer to as the wholesale market. And then the retail market is where you have either the same type of bonds or specific bonds that are directed at retail investors and that are sold not through auctions, but directly to the investors. And I think Thailand has been quite successful with that. Italy has been very successful, but maybe we can talk more about that after the next presentation. So with that, I will hand back to Bernard.
Great, thank you very much, Lars. That's a really rich presentation of international experience and guidance and advice. I do want to ask the members now if they have any questions. I'm giving a couple options. First option, just to write your questions into the chat, or if you'd like to just say it verbally, you can in a sense, raise your hand either through the on screen. I'll look for you that way, or through the icons, the emojis, reactions that are posted. There's a raise hand feature that's available as well, which I just did. So let's see if there are any questions. We maybe have about 15 minutes. So I would just encourage you to make your questions or comments very brief. And then Lars, also, if you can perhaps keep your responses also relatively brief so we can open it up to as many as possible. And if the Secretariat sees someone wanting to speak and I missed them, then please feel free to help me out on that.
Good morning. Hi. I would like to read the question.
Can you also just say what country you're from before you ask your question?
My name is Sivai Vilay Hans, B Corp from Lao PDR.
Yes,
thank you for informative presentation. I just want to read the question related to the how to promote domestic bond, mainly in the small country like Laos, because that the speaker mentioned that Indonesia and other countries, because they're big, they can promote many of government bond. But in case of Laos, we still in terms of debt management, we still meet the due date. We try to do our best to pay our debt in the due date. But in case of promote our domestic, because as you know, it's difficult to access to international market now. Maybe if it's one case for Laos is to promote the domestic bond. This case, maybe the speaker can share the experience, mainly for the small country like Laos. Thank you very much.
Perhaps, Lars, before you take that question, maybe if we could take one more question from Pakunta.
Okay, thank you, Bernard. Thank you, Lars, for your explanation and your presentation. It's very clear for us about the debt management. I think every country already done well for manage the debt. But my question is about, it means that we have a very high or rocketed the debt accumulation in that situation. So what do you think about when we need to start to consolidate the debt? It means that when we need to decreasing the debt to make our fiscal policy become more sustainable and to make our government intervention still there, is because right now in the situation, government the only one that need to intervene the economy. So in the same time, we need to consolidate it to make our debt not increase highly. So when we need to do that in this situation. Thank you.
To you, Lars. And I will take it.
Thank you. These are very, very good questions, both of them, and they're very complicated, right? So let me try to address them. CY on Lao domestic market development. Domestic debt is attractive in general because it's in your local currency, right? You don't have any FX risk. Having said that, domestic debt in developing countries is often quite short term. And what you want, and as you say yourself, is you want to ideally to be able to do what Thailand and Indonesia are doing, namely issue long-term debt. So what is the challenge in Laos? Well, as you say, it's a small country, and the challenge is that you have a very narrow and small banking sector, because the place to start borrowing and start a domestic market is typically to issue to the commercial banks. They will be the ones that are interested in having exposure to the government, in extending the maturities of their portfolio, because without the government market, what the commercial banks can invest in is monetary policy instruments, and those are typically short term. So there will typically be a bit of interest for longer, but it will take time, right? And the challenge and where this becomes really difficult, especially in a small country, is to expand the investor base. So you want to be able to attract pension funds that will be interested in longer maturities. What you have seen in small countries in Europe is that the way they developed, the real big kick to market development came when foreign investors became interested. But I think it's fair to say that you are a long way from that in Laos, right? And not only do you only have a few larger banks, but those banks are also state-owned, which makes this even more complicated. So, I mean, I cannot tell you how you should develop your market. I can only tell you that you need to be patient. And I think you definitely need to start in the short end of the curve, meaning, for example, start issuing a 2-year bond, a 3-year bond, get the market used to how you issue, be predictable. I mean, have an auction calendar, use a standardized way of issuing, and then you have to have regular conversations with the investors, get to learn what they would like. That doesn't mean that you should do exactly what they want, but definitely listen to them. And I think that's sort of I know this is a deeply unsatisfactory answer, but I mean, it takes time, and there's no easy way to do this. We have an engagement with the Minister of Finance in Laos on debt management, and market development is one of the topics that have that. But it's also, I mean, it is complicated at that, but Sivai, please come back if you want to discuss further, and I'm happy to give you more background information and ideas and lessons from small countries. Kunta, your question was even more difficult. So I am sort of arguing, both indirectly and directly, that in this situation there are good reasons for borrowing more. There are good reasons for spending more, because you have these emergency requirements. And when do you start moving the other way? And that's a difficult question, right? Because I think it's clear that this thing will not go away fast. That means that I think the spending needs will continue, and there are different. You know better than I that there are very different philosophies on how you go about tightening fiscal policy and when you do that. I mean, and this is actually also one of the examples where it's much easier in Europe and in the US, because you have 0 or negative interest rates. That means that it's actually easier to make these decisions and say, well, we are increasing spending and we can have some patience. Even if we borrow more, the debt to GDP is not going to grow much, if at all. But that's not the case in many of your countries, right? If the interest rate at which the government is borrowing in Indonesia is 6 or 7%, well, that makes a big difference, because this will mean that the cost of the debt will grow much faster than the economy in this situation, right? So is this the good time to, when is the good time to tighten policy? Well, that's why we invented politicians. But I think that I find it, and this is sort of my personal view, I find it hard to seriously argue that even in the next year or two that you should think seriously about the tightening policies. I think that would be the risk that you're making grave mistakes and that you're completely stopping economic growth. I think those risks are substantial. So I think that those were two clearly unsatisfactory answers to two very good questions. There's a question in the chat from Vietnam about methodology and toolkit to identify the desired debt portfolio, and that's a question I can answer. We developed with the IMF years ago this what is called the MTDS tool, medium-term debt management strategy tool, which allows you to compare borrowing strategies up to a 10-year horizon, where you can say, well, if I borrow this way with these macroeconomic assumptions, how will my debt develop? How will my cost and how will my risk develop? So that tool is available, and you can either send me an email or you can Google MTDS and World Bank, and you will get to a website where you can find all this information. So there's an Excel spreadsheet, and there's a note that will explain how the toolkit works, and there's this background note that is sort of a more theoretical paper. There's one question more from Vietnam about operational risk management that has a similar regulatory institutions to Vietnam. That one again, I cannot give a satisfactory answer in the amount of time that we have available, but there are certainly standardized methodologies to address operational risk. I mean, if you're interested, I can share some papers. Right now, I'm involved in some work in South Africa, where we are sort of trying to help them identify not only all the operational risks, but also how important are they? Because you may have hundreds and hundreds of different risks, but not all of them will be likely to materialize, and some of them that materialize will not be important. So that exercise is something I think is fairly standardized, even for Vietnam, but I'm happy to come back to that. Bernard, back to you.
Yeah, maybe I'll just take the opportunity to just ask also a question. You mentioned in your presentation the need to not only understand what the financing needs are of the government, but also to be able to communicate back if the debt management office doesn't feel like they can raise that level of funding. And so how do countries, as they look at perhaps increasing debt, try to really assess whether what that balance is, whether they can continue to access debt financing or need to start scaling it back? And with that, what was the reason for these solidarity bonds? Was that also because they were experiencing some difficulty, and this was a strategy to expand the base of potential investors? If you could give a bit of reasoning behind the solidarity bonds.
Yeah. So let me start with the solidarity bonds. So they have been labeled differently from country to country, right? But it is really about broadening the investor base and getting also retail investors, so normal citizens involved in investing small funds. It's about creating this sense that we are in this problem together and we need to find solutions together. But I think the essence of it is that you want to expand your investor base. And I actually, when we talk about, and this is sort of a sidetrack, not completely, but when we talk about green bonds, it's basically the exact same thinking, right? When you issue green bonds, you're typically targeting international institutional investors. So here we talk about big bonds, often international bonds, but at the same time, it's an attempt to get access to investors that would normally not buy your bonds. And it's the same thing with the solidarity bonds. I think that the question on how do debt managers communicate with the fiscal policy authorities, which is I think that's sort of the essence of your question. And that's a really interesting question, because in some countries this doesn't work at all, and there's very, very little communication between fiscal policy authorities and the debt manager. We also have examples of, and here I can go back 20 years in Brazil, and you may be aware that in Brazil they have, especially in the beginning, late 1990s, beginning of the 2000s, they went from one crisis to another. And that the debt management office was created in the midst of a financial crisis, and actually has had as an important function to inform the minister, this is how much we can borrow. And that sort of put a brake on some of the initiatives that the Minister of Finance could take. But I think the more common example is one where the Ministry of Finance will decide, this is the fiscal policy, this is the expected budget deficit, and the task of you guys in the debt management office is to raise the funding no matter what. And of course the result can be have long-term implications if you put too much pressure on your domestic market. If you force the state-owned pension fund, for example, to buy your bonds, it can have it may get the funding in the short term, but in the longer term it may have negative effects. So this is actually one of the areas where a committee, I was talking about this temporary committee, a crisis committee, but actually having sort of a high-level committee where the key people in the Ministry of Finance and Central Bank and Debt Management Office can meet, for example, every quarter or every 6 months and discuss these issues. And among other things, discuss the funding needs. And because the debt manager should be able, I mean, it's not always just saying that, well, we cannot raise this amount of funding, but it's also to inform the minister that yes, we may be able to raise an additional 100 million, but it will come at higher cost, and this will be the impact on the budget. So I think that's one of the important tasks of the debt management office.
We only have 2 or 3 minutes left, but I see that there is one hand raised from Ms. Gambold, I believe.
It's Bolorma, and she's definitely going to ask a complicated question.
Okay.
Hello everyone, my name is Bolorma. I'm from Mongolia, Ministry of Finance. So I have a two quick questions to Lars. So the first question is, our situation is challenging in a pandemic, COVID pandemic, because 2017 we stopped to issuing a domestic bonds in domestic market, but now we just starting our auctions in domestic market. So could you please how to reduce the operational risks beforehand to starting auctions in domestic bond market? This is the first question. And the second question was, you mentioned to the increase the coordination between the central bank coordination, but also the increase the central bank funding. Lars, could you please give us two more specific examples on this issue? Thank you.
Very much. So I'll try to be brief and hopefully precise. On the domestic bonds, yes, Mongolia is actually a very, very unusual example where the Ministry of Finance decided that they didn't like the prices in the market, and they stopped issuing, and basically were out of the market for 3-4 years, which is highly unusual. Because in most countries that you do need the domestic funding, and the banks do need that financing instrument. When you restart the market, and how do you reduce operational risks? Well, I think the key is to talk to the market participants, to have ongoing conversations. So communication and testing. I think testing of the systems, that means have fake auctions where the different market participants make bids, you ensure that everything works. So testing of the systems, make sure not to overcomplicate things. Make sure that you provide calendars so that the market participants know when the auctions are and what will be issued. So I think that's some of the basic issues. Central bank funding. I think the principle and best practice is that you don't allow the central bank to participate in primary auctions. That means you don't allow the central bank to buy directly from you, because the central bank is, at the end of the day, the central bank is yourself, right? It's part of that close family that is the government. And I think in a few minutes we're going to hear from Indonesia, and they will tell you something completely different, because they are allowing the central bank to buy bonds directly from the issuer. And I think in a crisis situation, in a crisis that is as serious as the one we are in the midst of, you do have to think outside the box, and you do have from time to time to say, yes, these may be best practices, and this may be the principles that we are normally following, but now it's different because the world is different right now. But when it comes to central bank funding, best practice is that if you have access to overdrafts, that you have a limit in timing and amount, that you don't allow the central bank to participate directly in the auctions, but they can buy bonds in the secondary market. And the idea behind that is to avoid creating inflation. And I think that's something that is where what we hear in many developing countries is that they say, well, yes, you say we should not let the central bank fund ourselves, we should not let the central bank participate in the market, but then look what happens in the US, what happens in the EU. But I think the answer to that is that in those two areas, the situation is fundamentally different, with super low or negative interest rates, and that means that the inflation, we are actually in this, well, they are actually in a situation where the central banks would like to see more inflation, right? And I think that's where you definitely, as Mongolia, is in a different situation. I know that this was that, and Bernard is going to say this was the final question, and I have to apologize that I think that my answers have not been very useful, but you have asked way too difficult questions, so that's my excuse.
Thank you very much, Lars. High expectations, but I think I'm sure you've risen to the occasion, and thanks very much. I think good opportunities for follow-up, perhaps. The next session is really will be focusing on 3 specific country experiences, and my colleague from the World Bank, Alexei Palabushka, is going to moderate the next session.
Thank you, Bernard, and good morning, everyone. So as Bernard just mentioned, we're moving to the next session, which focuses on country updates, and we'll hear from 3 countries, Indonesia, Korea, and Philippines, about their developments in debt management as well as challenges. And I'll have to ask everyone to try to speak for up to 10 minutes. So without further ado, in the interest of time, the first speaker is Dr. Eravati, and she's an acting head of Subdirectorate of Financing and Fiscal Risk Budgeting at the DG Budget Ministry of Finance, and also head of Subdirectorate of Data and Technical Support of State Budget Preparation. So Dr. Eravati, over to you.
Thank you. Good morning. I will share the presentation.
Thank
you. Can you see this presentation?
Yes, but not on the full screen.
Okay. Good morning, everybody. I will presentation with the title of Indonesian Debt Management Strategy during and post-COVID-19 pandemics to maintain fiscal sustainability. COVID-19 became an unprecedented crisis which gives shocks on the demand and supply side and give a domino effect to various sectors. In Indonesia, the government has imposed a public health emergency status and established large-scale social restriction since March 31st, 2020. The government has also formed a task force for the acceleration of handling COVID-19, enforces a physical distancing policy, and established a state of emergency for COVID-19 and etc. This step resulted in a significant reduction in economic activity in the real sector. Pressure occurs both on the demand and supply sides, which in turn will suppress economic growth. Indonesian economic growth before COVID-19 was 5.3% in State Budget 2020. Past COVID-19, Indonesian economic growth was negative 2.07% based on realization. The decline of economic activity creates the threat of layoffs, which result in a decrease in people's income, which in turn has implications for the level of consumption. Production activity are also hampered due to disruption of supply chains and distribution flow, as well as falling investment. The spread of COVID-19 that was very easy, fast, and widespread in the world also poses a serious challenge to the stability of the financial sector. The heightened uncertainty in the economic has damped confidence in financial market. Therefore, the government needs to take extraordinary steps both in the real and financial sector through a mix of various fiscal and monetary stimuli. In Indonesia, the fiscal stimulus is focused on the health sector, social security, industrial support, and economic recovery. The pandemic has had an impact on the 2020 fiscal year state budget. State revenues are expected to experience a fairly large shortfall due to the deteriorating economic situation. At the same time, the extraordinary step requires that state expenditure and investment financing must be increased, so that the impetus for the state budget to the economic is greater to hold the economy from becoming worse. A widening deficit was inevitable, and therefore government debt increased. As the legal basis for the extraordinary policies, the government issued government regulation in lieu of Act Number 1/2020, which was later ratified as Law Number 2/2020. With this law, the budget deficit can exceed 3% until 2022 to carry out various extraordinary policies that are needed. In 2020, the government widened the deficit to 9.34% through the issuance of Presidential Regulation Number 54/2020 and 72/2020. Widening the deficit above 3% of GDP is to accelerate the mitigation of COVID-19, salvage the economic from threatening crisis, and maintain the stable financial system. As one of the extraordinary steps in 2020, the government has implemented COVID-19 Handling and Economic Recovery Program, or PCPEN, amounted 695 trillion rupiah that focuses on the health sector, social protection, business incentives, SMEs, sectoral and regional government, and corporate financing. The large amount of additional funds required to undertake extraordinary measures requires the government to share the burden with the Bank of Indonesia. One of the goals to be achieved from this burden sharing is so that debt interest payment do not increase sharply, so that fiscal sustainability is more maintained. Oh, sorry. The next presentation is about 2021 fiscal policy direction and strategies. National Economy Recovery Program in 2020 is expected to continue in 2021. After experiencing considerable pressure in 2020 as the impact of the COVID-19 virus, in 2021 the economy is expected to experience improvement. In 2021, the state budget prepared with the theme Acceleration Economic Recovery and Strengthening Reforms. The National Economic Recovery Program, which was implemented in 2020, will be continued in 2021 to strengthen pandemic handling, including mass vaccination program and acceleration of economic recovery program. In 2021, will also mark the beginning of the expansionary consolidative policy toward a deficit below 3% in 2023. To support the direction of fiscal policy in 2021, one of the strategic steps that will be taken is to encourage the national economic recovery process, accompanied by policy reform, both in terms of state revenue, state expenditure, and financing. Reform of state revenue policy is aimed at encouraging the mobilization of state revenue, both in terms of taxation and non-tax state revenue, or PNBP, so that is more optimal in order to support increased investment and national competitiveness. In terms of state expenditure, refocusing on state expenditure policies is aimed and encourage more optimal and well-targeted allocation of state expenditure. From the financing side, policies are directed at supporting the deepening of national financial market, so as to support the involvement of the public and the private sector in financial national development. This is about a debt trend. The higher debt financing is required to support budget deficit widening due to COVID-19 pandemic. In the last 5 years, the government has consistently implemented an expansionary fiscal policy to accelerate national development, while at the same time maintaining the momentum for economic growth to remain high and sustainability. The implementation of the National Development Program, which is supported by high economic growth, is an important asset for the government and its effort to reduce poverty and increase the welfare of the nation. The expansionary fiscal policy is actually a strategy implemented by the government to avoid opportunity loss in line with the increasing achievement of various national development targets. To support the implementation of targeted and measurable expansionary fiscal policy, the government implements a budget deficit based on strengthening of sound and sustainability fiscal policy management. The debt ratio in the 1998 to 2019 period shows a downward trend. Although in recent years it has increased slightly. The increase in the debt ratio is in line with the widening fiscal deficit, primarily to support acceleration infrastructure development. The debt ratio is still maintained at around 30% of GDP, which shows the government's commitment to managing debt with prudent principle. In the 2015 to 2019 period, the debt ratio increased from 27.4% to 30.3%. In 2020, when the COVID pandemic occurs, the debt ratio will increase to 38.7%. This is due in addition to the widening deficit, exceeding 3%, as well as the economic recession, which has an impact on the decline in Indonesian GDP. Even though there was a significant increase in the debt ratio, is still below in the limit stipulated in the Act maximum of 60%. Debt financing needs to support handling COVID-19 impact. The 2021 budget deficit is 5.7% of GDP, or 1,006.4 trillion rupiah. In terms of size, the value of debt financing in the state budget has higher value than the deficit target, because debt financing is not only used to finance the budget deficit, but also it used to finance non-debt policies investment. It is planned that the deficit and government investment will be met through debt financing from the issuance of government bonds and loan withdrawals. In general, the debt financing target will be met mostly in rupiah, around 80 to 85%, through the issuance of Indonesia rupiah bonds and domestic loans. The rest will be fulfilled in foreign currency, is about 15 to 20%, through the issuance of foreign currency bond and foreign loan. Gross bond issuance is carried out by auction and non-auction, where conventional bond still takes largest portion, is about 98 to 73%, while the rest 27 to 32% is planned to issue Sharia-based bond.
Dr. apologies.
Okay,
if you can finish in 1 or 2 minutes, that would still allow some time for the questions later on. Thanks a lot.
Yes, this is the last presentation. It's the debt strategy. In 2021, the government plans to strengthen the debt financing policy focused at 1, to fulfill budget financing and refinance matured debt and optimal cost and tolerable risk. Second, to support the development of a deep, active, and liquid domestic market, and to improve the efficiency of debt management in the long term. And third, to promote public accountability as part of transparent government debt management in order to create good governance. Thank you.
Thanks a lot, Dr. Abati, for an excellent presentation. And the next presentation, we will actually hear from Ms. Don Soo Lee from Korea. And Ms. Donsuri is a Deputy Director of Fiscal Management and Coordination Division at the Ministry of Economy and Finance. So over to you. Misty, can you hear us well?
I can hear you.
Okay, excellent. Dr. Ravati, I think, yeah, that works. Go ahead with your presentation. You see,
Okay.
Okay, excellent.
Yeah. Hello, everyone. I'm Dong-Sun Lee from Korean Ministry of Economy and Finance. I will make the presentation about Korea government's response to COVID-19 and debt management. First, I will explain how the government fiscally responded to COVID-19. And next, I will talk about the necessity of debt management. Lastly, I will present about fiscal stability measures. Okay, first is how the government responded to COVID-19. Before that, I will provide data on the current status of COVID-19 in Korea. The first case was reported on February 14th in 2020. As of April 19th, 2021, the total number of confirmed cases amounts to 114.6 thousand, and the death toll stands at 1.8 thousand. It seems that the virus lost steam after the number of confirmed cases hit a record high, but it began to spread widely starting from February. According to the latest update, the number of cases reported daily is around 600 to 700. To reduce the spread of COVID-19, Korea is implementing social distancing policies. Gatherings of 5 people or more is banned, and 13 businesses are restricted and closed. When it comes to fiscal response, the first supplementary budget prepared for COVID-19 amounted to $10.5 billion in 2020. It was followed by 3 more extra budgets worth at $49.5 billion. So the total supplementary budget in 2020 worth at $60 billion. $502.2 billion were prepared for 2021, with additional $13.4 billion earmarked in March, leading to the total budget amount at $515.6 billion. The sound is okay for you? Is it too small? Excuse me? The sound is too small or okay?
And no, it's fairly visible.
It's okay?
Yeah, it's okay. Please go ahead.
Okay, continue. With the increase in budget spending for COVID-19, a projected debt-to-GDP ratio presented in the framework was also increased. The blue line indicates medium-term fiscal outlook for 2019, and the red line that of 2020. In 2019, the debt-to-GDP ratio was expected to reach below 50% by 2023. However, the 2020 figure was revised that the debt-to-GDP ratio will be higher than 50% starting from 2022. Unfortunately, the level of growth in debt to GDP ratio is moderate compared to other advanced economies. According to IMF, Korea's general government gross debt ratio increased by 6.4% in 2020 compared to 2019. This is relatively lower than that of developed and advanced countries at 13.7 percentage points and 16.3 percentage points respectively. In addition, Korea's debt to GDP ratio is less than half of the OECD average, 110%. However, as you know, Korea has the fastest aging population. Aging population is leading to higher welfare spending, and slow growth is weakening tax revenue collection. These circumstances will push debt level upward. It took 34 years for the ratio to move from 10% to 20%, and took 7 years and 9 years to exceed 30% and 40% for each. But it only took 2 years to go beyond 50%, and it is expected to take only 3 years for the ratio to jump to 60%. According to longer-term forecasts, the debt to GDP ratio for 2060 will surpass 81%. This means that Korea is following advanced countries' development track. Lastly, let me talk about the government's fiscal stability measures. Multilateral approaches are being considered to strengthen financial capabilities coming forward and secure fiscal sustainability. First is the adoption of fiscal rules. We are currently on the way to regularize fiscal rules so that we could spend public finance where required in a sustainable manner. In October 2020, we announced the plan for fiscal rule and submitted the revision of the National Finance Act to the National Assembly in last December. The debt to GDP ratio and budget balance are in a trade-off relationship. If one indicator surpasses a threshold, the other one should be adjusted to move below a threshold. By doing so, the fiscal rule will be met. For example, if the debt to GDP ratio is 50%, budget balance has to be adjusted to go below 3.6%. Until now, that ratio is under 60%. The government has more flexibility to manage budget expenditure. However, if that ratio goes high and surpasses 60%, budget balance has to be adjusted to go below 3% to satisfy the target. Secondly, spending restructuring is underway. We have been closely monitoring developments in the economic recovery and undertaking decisive spending restructuring to assess the speed of expenditure growth. To secure fiscal sustainability of post-corona era, we are trying to normalize last year's temporary increases in funds, loans, and derivatives. Furthermore, overlapping and duplicated programs will be streamlined and implementation failure will be addressed. Current spending made within the public sector will be reduced, such as administrative costs and travel expenses. By this means, until 2024, the gross expenditure increase rate will be around 4 to 5%, and the fiscal balance will be around -4%. We are also expanding tax base as a last resort effort. Tax exemption and reduction policy are being adopted to increase tax revenue and crack down on tax avoidance. The presentation was just a snapshot of Korea's effort to maintain fiscal sustainability. Still now, Korea Ministry of Economy and Finance is working hard to develop more measures. Thank you for listening to my presentation, and I hope we have an opportunity to discuss more about the Korea case. Thank you.
Thank you very much, Ms. Lee, for a very informative and right on time presentation. So with that, we'll be moving to the third country update from Philippines. So Mr. Eduardo Marinho will be giving us an update. He's currently a director of the Asset Management Service in the Philippines Bureau of the Treasury, and he supervises overall cash and investment management operations in the Treasury of Philippines. So, Mr. Marinho, over to you. Thank you.
Good morning, everyone. Sorry, just want to confirm the slide is clear and visible to all.
Yes, I can see it very well.
Okay, thank you very much. So good morning, everyone. On behalf of the Bureau of the Treasury, it is my pleasure and honor to be presenting to you some updates of what we are doing in terms of debt management under the specter of COVID now. So, okay, well, this is where we are essentially. So, as of 2020, as you can see, our debt to GDP ballooned from 39.6% to 54.6% of GDP. And you can trace the reason for that is because of the immense deficit requirement necessitated by the COVID response, and actually just the reduction in revenue, in fact, because of the COVID pandemic. So it was basically a doubling, more than a doubling of the more or less a doubling of the deficit from the original plan of about 671 billion pesos, or 3.2%, to 7.59% of GDP. So of course that means that you have to borrow. So that's the long and short of it. Debt to GDP increased because of higher deficit.
Mr. Marinho, we cannot hear you or see you. Are you connected?
Marinho, can you hear us?
Mr. Marinho, if you can hear us, could you reconnect?
I think given that Mr. Marinho has some troubles with connection, maybe we can actually start using this time to, if anyone has any questions on the first two presentations, feel free to raise your hand and ask them to both Korea and Indonesia representative. And meanwhile, if Mr. Marinho reconnects later, we can essentially kind of try to finish the presentation before we end the webinar today. Any questions? Also, feel free to post in the chat. So we don't
Received an email from Mr. Marinho saying that he's trying to reconnect. So if you could please wait
excellent.
a minute.
Certainly, yeah. If we hear from him, we can.
Alexia, I think Vietnam has a question.
Yes, we are having a question. So we are interested in Indonesia's experience in how to get the funding from the central bank. So we are interested in the size of your funding from the central bank. Have you got any experience so far? And what do you think about the impacts on the market and on the economy?
Thank you very much, Vietnam. Dr. Rawati, would you like to take this question on the size of the funding from the central bank and also impact on the market?
Okay, I will invite to Ibu Melissa to answer the question. My colleague.
Thank you.
Sorry, what was the question again?
So the question was from Vietnam that they're interested in your experience in actually using central bank to fund some of the debt. So they're interested in the size of the funding directly from the central bank, as well as your experience with impact on the market. Thank you.
So the size that has been capitalized by the central bank is purely for the countermeasure of the COVID pandemic. It is around 700 trillion in rupiah. Sorry.
Can you please share with us the relative number? What is the percentage of your total borrowing?
Sorry, percentage of what? The 700 trillion over what exactly? We have like I mentioned before, we have around 700 trillion in rupiahs to countermeasure the pandemic. That's for the stimulus. It is only for the stimulus in 2020. So it is around 700. So it is a quarter of the total expenditure in 2020. I'm not sure for the 2021. I'm sorry, Bu Era. Hello, sir. Am I already answering your question, or should I elaborate more?
It's okay. We've got the answer. So we would like to know more about the impacts on the market and then the economy, if you have any information.
Can I try to answer? I think in 2020 we collaborate with the central bank to absorb our what is called bonds or our bonds, especially Melissa mentioned, the bond is only cover what we have a stimulus. So we have stimulus package around 700 trillion, and most of this stimulus is financed by central bank. So this is upside of our regular bonds. I think our regular bonds, I'm not sure, that is around in 2020 is almost to 2,000 trillion. Yeah, so 700 trillion is almost 25 and 30% of our in our debt, and the impact to the market is not very huge because this is upset of our bonds, and the the central bank is go to the primary option. So it means that they go to the market even though they can it means that how many the market absorb, the rest is goes to the central bank, something like that. Is still
Secretariat, apologies, I just recently logged in. This is Ed Marino from the Bureau of the Treasury of the Philippines. May I ask if you can flash this presentation for me? Of course, after the Q&A is done. I'm using my phone now, so sorry. Thank you.
Thank you, Mr. Marino. But Kunta, I'm not sure if you are done with responding to Vietnam question or you would like to add anything else.
If Vietnam still have.
Thank you very much. We are okay with the answers now. Yes, thank you very much.
Excellent. Thanks a lot. And Mr. Marino, I guess it's now back to you, and please continue your presentation. Thank you.
Right. So can we go back to the previous slide, Secretariat? Yes. Okay. So where was I? Okay. So that was a perfect example of what the technical, the need for technical backups and the operational risk. So the basically, so higher debt because of higher deficit. That's basically the long and short of it. But debt management is, of course, as mentioned by Lars, all about managing the composition of the debt structure. So in this case, one of the things we were conscious about is the mix between the domestic and external funding mix. So we want, as much as possible, to rely on domestic sources of financing rather than external because of our experience in past crises. So that was for 2020, and for 2021, it's more or less the same picture. Very high deficit requirements entail high borrowing requirements, and we want to maintain that deficit, mix, as already mentioned. Next slide, please. Now, debt management is also fundamentally also about communication, assuring your investors, your credit rating agencies, and other stakeholders, communicating with them properly, regularly, and assuring them that you have things under control. And this is some of the measures that we are always keen to look at. So while the debt to GDP is quite high, 54.6%, I think it's also important to note that who owns those debt? A lot of it are owned by state-owned enterprises who are only owned, of course, by the national government. So if you net them out, then the figures start to become a little bit more manageable. So it's basically 7% of reduction if you net out the intra-public sector holdings. And of course, if you look at the figure in the bottom of the screen, so you have foreign participation in the domestic market at around 2 or 3% of GDP. So they are not, even if all of them dump the government securities, it's not going to be substantially disruptive to the economy or financial markets of the country. Now, one of the important things that we are looking at is the interest payment over expenditures ratio. So it basically, the higher that figure is, the more the more essential COVID-related expenditures get crowded out. So there's no point of borrowing more if most of your borrowing will be used to be paying your interest expense rather than the COVID-related programs. So So while we had a higher debt burden, it did not really translate to a higher ratio of interest payments over expenditure. So in that sense, it's still sustainable. The other thing that we are looking at, so that means because we want to keep those IP mix interest payments low, we prioritized short dated instruments. So that's why you can see a lower average maturity compared to previous years. Now, of course, 7.56, 7.57 is still quite high relative to the our ASEAN peers, but it's clearly a reduction from what we have been used to seeing over the last previous years, and that is the trade-off we decided when we prioritize a lower IP expenditure ratio. So that's one of the debt management decisions that we have made. And of course, as you can see in the average interest rate row there, it's also much lower than the previous years. So that's the result. Next slide, please. Now, a lot of one major reason why we keep on seeing the interest rates remain to be relatively subdued or at the sustainable levels is because of the very strong demand for our debt. This is the bid to cover ratios for our auctions. So this is calculated by dividing the total demand, the total tendered bids over the total offered amount for our auctions. As you can see, demand is more or less for 2020 and 2021, it's more or less 28 to 20.9 times the offered amount that we are tendering. So it's even higher when compared to the when the Federal Reserve was conducting its quantitative easing program. So this is a result of the initiatives we had in improving the capital markets, strong balance sheet fundamentals of the banking sector, and of course the support, the implicit promise of the central bank to purchase all of the to participate in the secondary GS markets. That's leading to these results. So it's a combination of all of those factors. So the central bank doesn't have to be actively participating. Sometimes the mere promise that they will be there to take off, to buy back the debt that you purchase from the government is enough to generate these types of results. They work on expectations, in short. Next slide. And this is just the another graph showing the fact that we have been getting very low rates, especially right now when supply side inflation is hitting the country. So over the past 2 months of 2021, we have been seeing inflation average from 4.5 to 4.7%. Nonetheless, we are still seeing relatively low rates compared to those levels. So it's actually more or less negative real rates if you think about it. So again, a result of the all of the factors I mentioned earlier. And this is a very big reason why we are confident that even though we have a higher debt burden, it's not going to be unsustainable. Next slide. So now, fundamentally, reducing the debt is all about reducing the deficit and of course increasing GDP growth. So with the deficit, the lower deficit levels means lower debt levels in the future or lower borrowing levels in the future, and a higher GDP growth rate will nonetheless mean that your denominator for debt to GDP is also much larger. So those are the two critical factors that's going to dictate whether or not we return back to sustainability. And this is just a fan chart that we have internally produced. Now, but the critical part there is, of course, regardless of the total levels of debt, we want to make sure that most of it will be funded by local currency. At least sourced from domestic sources of financing. I think that was the last slide. Next slide.
Yes, thank you very much, and I hope I was well within the time, and I apologize for the technical delays or difficulties. Thank you.
Thank you very much, Mr. Marinho. And I think if Secretariat allows us to go over time slightly, we may have time for several questions at least. So if there are any questions to our presenters from Korea, Indonesia, and Philippines, please raise your hand or post in chat and go ahead and ask them. Thank you. Okay, so while we are waiting for the questions, actually there was previously a question from Vietnam to Indonesia, which is I think fairly straightforward, and just asks for Indonesia representative to essentially explain what does it mean cash debt in the last slide. So Dr. Arawati, I think it would be a question to you.
Yeah, thank you. Maybe it's that not cash debt, but cash management maybe. I will invite Pak Erwin from DG Budget Financing and Risk Management and Pak Kunta to answer this question.
Thank you. The question is very straightforward actually. The cash that's in the last presentation is actually the sum of the issuance of government bonds and the loan disbursement or the program loan disbursement from multilateral and bilateral loans. So that is the gross, it's equivalent to minus the disbursement for loans. Thank you, Bernard.
Thank you very much. So any questions to our presenters before we start coming to conclusion? Okay, so I guess if we don't have any questions, so I'll just say a few words and actually start by just thanking everyone, all the speakers and presenters for both very thought-provoking and informative presentations, as well as I think excellent discussions and good questions that came from all participants. And also have to say that the issues of debt and thus debt management are becoming increasingly important in both pandemic period as well as post-pandemic recovery, to ensure that all the important programs get financed, but fiscal sustainability also is maintained and risks are minimized as well. And today's webinar has really provided us wealth of experience from different countries as well as the World Bank work in this area. So with that, I would like to thank to everyone and hand over back to PEMNA Secretariat for some announcements. PEMNA Secretariat.
Thank you very much, Alexi. Thank you all for participating in today's CoP webinar. We'll be posting the recordings and slides on our PEMNA website soon. And we're going to be sending you an evaluation survey, and we'd appreciate it if you can respond to that. We have another webinar scheduled for tomorrow, which is the PEMNA CoP webinar on cash management, with a focus on the impact of COVID-19 on cash flows and liabilities. If you're interested in participating in this webinar, please send us an email and we will send you the link soon. Thank you very much for participating today, and we hope to see you soon. Bye-bye.